guys, we're going to go ahead and move directly into our first guest then. Brian Knepper is with us. Brian, if you'll wave to everyone for a moment. And I'm gonna pin Brian's video so I think that it becomes the large one for us. And Brian has become a friend of the school. Brian is with StatMD, and he's agreed to come in and spend a little time talking to us today about some of his experiences and about this whole public and private capital markets from the perspective of someone who's had a career within them and who's had a career going into various companies, medium to fairly large companies, both public and private markets. And we'll talk to us a little bit about some of those experiences and some of the perspective and context of what we've been discussing for the last 3 weeks together. Brian, welcome, and thank you for being with us.
Thanks. Sure. So my goal today really is to use this time for you guys as students in the most productive way that you feel possible. So as I'm going through stuff, I'll take questions or you can save them to the end. It's really, how best you think to handle it. As Dr. Haskell said, my goal here, or my experience, is 10 years on Wall Street, all as on the buy side, meaning that I was investing in actual companies. Subsequent to that, I started StatMD, which is an urgent care company in West Jordan and Park City. But I've also invested in private companies personally and pre-IPO and given lots of advice to companies. So, I hope to be able to be a resource to you guys. I don't think I'll hit every slide. So if I do miss something that's important to you as students, please let me know. So, and my presentation is to my left here, which is why I keep looking off to it, just for your information. I believe that, the textbooks do give you a very strong foundation for understanding economic theory. That said, the real world does sometimes differ. We're all in this level playing field of going through, econ classes and perhaps an MBA, but real world negotiations differ sometimes from what the books are saying. A seasoned investor, a seasoned buy-side investor, again, someone who's making the investment, that could be a mutual fund, it could be an institutional investor, private equity, hedge fund, just somebody who's giving you dollars, a private person. They understand with experience that those looking to raise money can really make any sort of story or scenario look good. So on my first slide, I sort of talked about what are the most common investment models that I've seen presented. They're always, a form of discounting the future value of the company into today's dollars. That can be through discounted cash flow models, net present value models, and then you talk about more current stuff. If you want to look at a shorter term, if it's already a public company, you can look at price to earnings or price to sales, or the enterprise value to EBITDA, earnings before interest, taxes, and depreciation, amortization. And the enterprise value being defined as assets, basically assets minus the debt, what's left over.
Brian, let me interrupt
Yes,
for a moment. I know that you have a presentation. Were you wanting to share that on the screen, or would you prefer just to talk through things?
Oh, I assumed that they were looking at it or it was distributed.
They're not. Okay. We'll let you share your presentation by clicking on the green share screen icon.
Right,
and
give me
you
1
can
second.
also control the speed at which you're going through things.
Okay, sorry about that, everybody.
No, my bad. I apologize.
It's okay. I just have to launch it here. Does anyone have any questions while I'm launching it from my... Okay. Almost with you guys. Okay. Oops. Okay. You guys see that now?
Very good. We can see it.
All right. Sorry about that, everyone. So I'm still on this first slide. Actually, I'm not. I'm on the second. So get this out of the way. Okay. I I think that when you're telling your story to someone who's going to be a potential investor, having credibility is a major issue. You want to come to the table with, this is why, what we're doing, this is why we're raising the money, and these are the values that we're assigning to various outcomes. I've often been presented with things that say, and I'm just making these numbers up, but you can make a $10 million investment that'll turn into $100 million in 10 years based on this model. And that looks great, but it's not reality. The more effective way to communicate and raise capital is usually to say, here are 3 different or 4 different valuation models. Here are 3 different outcomes that are anticipated. And let me talk you through all of those. So it always starts with, here's a base case model. We think that if everything goes as planned, your 10 million will turn into 100 million. However, our worst case scenario, and usually the worst case scenario if it's a private company, is that the investment goes to 0. You should present that, because it shows not only a humbleness, but a realization that what you're doing is difficult, and a respect for the person on the other side of the table who's putting the money. So I would say the worst case scenario could be that we don't get the penetration we think, or we don't get the pricing we think. And in that case, the value of the company, instead of being 100 million, could be 50 million, or 8 million below your investment, whatever it may be. And then of course you're going to have your most rosy scenario, which will be your best case scenario. And you can provide probabilities to those perceived or those forecast outcomes. And I think that gives you quite a bit of credibility, because you're recognizing that the world is not perfect, and that things most likely won't play out as you're presenting. The biggest way that I've seen models manipulated is by using tweaking what's called the discount rate. So the discount rate is really a measure of risk. It's the return that the investor expects over the risk-free rate, which is traditionally U.S. bonds, Treasury bonds. By lowering that rate, even if you have a discount rate that says 5%, and you're applying that sort of risk metric to the cash flows, even a very small tweak of that by 0.5% or even 1% can have wild outcomes on the value of a company, because it's taking cash flows that are way far in the future and bringing them back into today's dollars. So when you have a higher rate, if you go from 5% to 6%, your valuation in the near term, your valuation looks lower, because it's putting more value on the dollars that are going into business today, which are outflows. If you lower it, then it makes the value of the company look higher, because it assumes cash flows are then coming in, that the company is earning money, and it's not putting as much weight on the initial investment, on the dollars that are going in to be invested today. So a good investor will say to you, well, what discount rate are you using, and why? The why is a very hard question to answer, even for someone who's done this for a long time like I have. There are historic rates that you can use. But again, I think there's no shame in saying, I took this because it was a reasonable historic rate. But here, let's run through some scenarios. Let's assume that there's more risk or less risk. I think understanding your model and understanding what it's telling the investor is important. Okay, so what does it mean for me as an investor to make an investment? I sort of boil it down to being super simple. I'm an owner of the company, and I'm making a claim on the future earnings of that company. Whether that's a company as large as Pfizer, in which I'd be a teeny tiny little, owner of the company, or a small venture that you're starting, which I might be a bigger owner of that company and the future cash flows. But it doesn't need to be more complex than that. There are lots of fancy terms about, well, you could have options and warrants that could bring your ownership to this or that. Again, to me, it doesn't matter. It's all an argument of how much of the company do you own, or do you want to own, or do you not want to own. There's lots of different investor types, as I mentioned before. Early stage investors, which are venture capitalists, have a much longer time horizon than investors in, say, public equities. And they also play a very different role, which is important to understand. When they're giving you capital, they're also lending to you their expertise. And they want to be involved in some of the decision making and perhaps in the board structure. They might want a board seat or board observation, it's called. But as the previous presenter alluded to, they are probably going to want some say. As someone who's just starting a business, you may say, I want a venture capitalist to be involved because I do want their expertise. I've gotten the idea together, but I'm not really a good operator. I've never operated a business. And so sometimes a deal is not always the same. If you have Brian Knepper offering you $10 million and you have a venture capitalist offering you $8 million, you might say, wow, the 10 million looks better. But in reality, the better deal for you, for your company, and for your existing investors may be to go with the venture capitalist because they might have more operating experience in the space, in technology. Say, my background is in healthcare. So I think that when you're evaluating a partnership with a future investor, these are all things that you need to consider. What is their timeline? Outside of money, what are they bringing to the partnership? Because you're giving up part of, if it's a private company or even if it's a public company, you're giving up, a stake in the company. Okay, so how do investors value ownership? I think that this slide is mostly self-explanatory. Term sheets are really what goes first. It's a non-binding agreement or outline for what will later be used as to create the legal, the real documents. And in these term sheets are things such as liquidation preference, who's going to be in the management roles, who's going to, which then dictates fiduciary responsibility. And you may also talk about forecasting of future investment needs or future capital raises. I had sent this on to Dr. Haskell before I did before I'm doing this presentation. And one thing that he pointed out about this slide, and he's right, of course, is that anything can be defined in a term sheet. It can be crazy things such as use of a private jet. I'm the founder of this small company and we have this small plane and I want to be allocated 10 hours a year to use the jet at the expense of the company. And the investor may say, well, that's a waste of money. No, but again, these are things that can all be negotiated in the beginning and outlined in the term sheet, which will later be used for the creation of the full legal document. The prior speaker was addressing fiduciary responsibility a bit, or maybe a lot. I didn't get to capture the whole lecture, but this is a key component of everybody's considerations, both sides of the table. So who do you have responsibility to? Current investors? Yes. Your current employees? Yes. Your vendors who are extending you credit or or supplying you? Yes, you really need to consider that you have a responsibility to multiple stakeholders, internal and external, when you evaluate a deal. And again, that in evaluating a deal, it's not always the dollars. It can sometimes be the total value of the deal, the experience that the investor may bring to you. One thing that's come up recently has been what's called ESG, environmental, social, governance factors. Sorry. This was always sort of a soft thing when I was involved in investing, because people would say, oh, well, we should be a paper-free environment. Therefore, we need more capital to invest in technology and computers. And it's better to not kill so many trees. Over the decades, and certainly something that we're seeing more and more outside of the U.S., is this real focus on ESG factors. And it's become much more developed than what I just laid out over time. The risks are being seen, as the slide points out, as financially material. We're seeing high performance correlated with, improved, high ESG performance is being correlated with good future financial performance. Consumer appetite for companies that are focused on ESG is important. So I'm going to buy more products from more paper towels from Procter and Gamble because they are using recycled materials rather than their competitor who might just be using fresh paper and pulp. So again, that could drive sales and an outsized market share shift. So I think that these are things that absolutely need to be considered, and they're always changing. Investor taste is changing. There's regulatory changes constantly that result from pressures from special interest groups or even from litigation. We recently saw Johnson & Johnson say they're going to stop producing talc. Baby powder has been around forever, but it's created some major lawsuits, and they decided that it was an outsized risk to continue to be producing that product. So, the bottom line here is that a fiduciary does have a duty to act in a prudent way. And I won't go through that because I did catch that part of the prior presentation. But I just want to lay out a story, an example of where this can become muddled because it's not so clean all the time. I went to advise a public company, a small company, on their strategy for a few years. And what I came away with was, you're about, a $5 million company in market cap, and they have $5 million in cash. So the first question I had was, well, why are you public? Being a public company comes with lots and lots of costs. To begin with, compliance costs and being sure, I think it was about $50,000 in order to be listed on the exchanges. Well, that's a lot of money to a small company like that. But the real rub that I had was they had a CEO in place who was very entrenched. And maybe I'll put it to someone in the class. This CEO had been at the company for 30 years and had specialized knowledge of the company and the industry, and had an outsized contract that had been given to him by the board of directors. He didn't agree with my assessment. So what do you do with someone like that? What do you do with someone who, if you have fiduciary responsibility, on the one hand, you have this specialized CEO, you can't easily fire him and replace him because he's got 30 years experience at the company in a highly regulated market. But on the other hand, you have fiduciary responsibility to your shareholders, and perhaps the financial end of things aren't being fully appreciated and cleaned up. So anybody have any ideas what you would recommend in that situation? Is my question clear? All right, I'll let you off the hook. So I was a third party.
This is Bill Curry. I guess I'm going to be a next speaker, but in those situations, and I've been in these situations before, you typically make a recommendation to the chairman of the board, and then let the board decide what to do from there.
Exactly. And that's what I did. I was an independent evaluator, and I said, he's getting paid too much. He has a contract that's very good for him personally, but bad for the company, which meant had huge change of control provisions, so the company couldn't be bought without buyout for him personally. And it was not to the benefit of the shareholder, yet at the same time, getting rid of him would also hurt the shareholder. Ultimately, because the board was also entrenched, they didn't make any changes. And I sort of walked away from that. It's disappointing to see things like that happen. I think it can happen in companies of all sizes, but sometimes inaction is the easiest path, but we need to remember that no action is also making a decision. Choosing not to do anything is just the same as choosing to do something. So All right, let me just try to pick up some speed here if I can. So,
Brian,
go
you
ahead.
might like to know that we spent a fair amount of time a little bit ago this morning on term sheets and pretty much beat up their Wild West in terms of whatever you want to go in them can go in them.
Yeah, I've seen some crazy stuff. All right, so let me just hit on, I'll skip that slide and go to just pre and post money valuation terms. These are terms that you're going to hear a lot in private rounds of investment. And I think that it's important to understand what they mean. And the cleanest example that I'll give is, company A is valued at $8 million. A venture capital company is going to come in and invest $2 million. How do we think about that? Well, the company prior to that $2 million investment is valued at 8. At post-value investment, it's 10, right? So it's 8 plus the 2 million that's coming in. And what this means is that the new investor, VC company A, is going to own 20% of the company, not 25%. How am I coming up with those terms? They're making $2 million investment or an $8 million company. You could look at that and say that's 25%, but no, it's actually how much do they own of the new company once they're put together. So that would be 2 million on a $10 million company. I just want to point that out so that you guys understand those terms, because thinking that you're going to own 25% is different than actually owning 20. And these are terms that you should be familiar with. I don't know did you guys touch on conversion yet and liquidation preference?
We did. We spent some decent time here. You might offer some ancillary commentary with respect to it from your experience, but we spent some time here.
So always when I was looking at things, or when I do look at things, what's important to me is liquidation preference and anti-dilution, because those represent to me the two primary outcomes. I've started my own enterprise, and I said this to many people. The most likely outcome, in my opinion, of a new enterprise that's starting is failure. It's very hard to succeed. No one goes into it thinking that they're going to fail. We all have the best terms. And I don't really know what the number is. Maybe you guys do, but to me, I always say like there's an 80% chance this is going to fail in 5 years. That ties into the liquidation preference end of things. If the company has to shut down, if I had to shut down my urgent care businesses, it does have some assets. We own an X-ray machine. We own our inventory, our lab supplies, our furniture, our computers, and they would be sold off. And the question is, who gets that money? And so you want to make sure, or the investor is going to want to try to make sure that they're high on the liquidation value list so that they try to recoup some of their investment if the business fails. I have, it's easy to say, but I've gotten liquidation preference and still gotten 0 on investments. I've gotten liquidation preference and then a bigger investor comes in behind me and gets, senior liquidation preference sort of things, and I still get 0. And the bottom line is that it never feels good to lose money, but to get a little bit of an offset, even if it's only cents on the dollar, you want to make sure that you're protected. Similarly, if you're at the company and you're talking to an investor, you don't want to give that up if you don't have to. So everybody's fighting for the same thing. Anti-dilution is also very important. I invested in a company that recently went public called One Medical. I went in as an individual investor, and a large group called Carlyle Group came in after I did, and they came in with I think $450 million, which was obviously head and shoulders multiples what I did. But I had in my agreement anti-dilution rights, which means you can't take me, little Brian Knepper, and bring in more money and more money and more money, which would be issuing more shares and dilute me to effectively having 0 ownership. Now, the way that usually works is, okay, Brian, we'll give you anti-dilution rights, but that means you have to invest more at the same rate of the next round. And if you don't want to do that, well, then that's your decision, and we're not diluting you. You're choosing to not participate. But I think, again, I think that's a fair thing to give investors, and I think it's something that they should be asking. Again, in public companies, much of this isn't material because you're not well. I was going to say you're not issuing new shares, but new shares can be issued in new companies, but I guess on a much different scale. But I learned this the hard way many years ago, didn't have anti-dilution rights, had a company that succeeded, but wound up with an insignificant ownership stake to even cover what my initial investment had been. So that's a painful lesson to learn. A good investment, or a good idea of making the right investment in the right company that did succeed, but not having it materialize into any profit. And the way to protect yourself, I believe, is through anti-dilution. There's a couple of different, types. I touched on the liquidation preference. Here's an example for you guys to see. Anti-dilution, I've put it, I just talked about, and ratchets is a type of it. Again, I think it's probably complicated to discuss, but I want you guys to see an example. And then the other thing here are dividends. That's basically, it's deferred interest. It's saying, I'm going to give you, $10 million at a rate of, 10%. So you owe me $1 million a year, but I'm not going to make you pay it right now. You're going to pay it at a set time or when the company IPOs. I think, it's a deferred expense. Again, it gives the investor some prior claim or some premium claim on future cash flows while not hurting the company today. We're saying if you succeed, you're going to owe us this money, and it's carried as a deferred expense. And let me just go back to the governance issue because it's critical to me. Who's going to run the company? What sort of rights do I have? And within that are what are called voting rights. Things slip through even into the public markets that are crazy to me personally. Facebook, for example, a company that we're all familiar with, has dual classes of voting rights. That means that Zuckerberg, and I don't really know I forgot what the actual structure is, but it might be that each one of his votes counts, 10 times to every one vote of the common shareholder. I think Google is the same way. WeWork, when it was coming out, was going to be the same way. I looked at the WeWork prospectus. I was just curious. I couldn't understand their business model, but right off the bat, it was a non-starter for me because Adam Neumann, the CEO, had outsized control. So me as a minority, with respect to voting rights, which would be used for major decisions, hiring and firing senior executives, whether to issue new shares, whether to go public, executive compensation, things like that, I would have no say. So even though I could own a reasonable amount of the company, I would have zero input into major decisions about how the company was run. And therefore, I was putting all of the power into, Newman or, Zuckerberg or whoever it is to do the right thing. And I'm just along for the ride. So dual voting, dual share structures are common. They can include different voting rights. They can include different payments. They can be preferred shares. I get money before you do. And these are all things to look out for. Again, it depends on which side of the table you're on. As the investor, I don't want you to have any of those rights, but if I'm you, I want all of those rights to myself. So, you are going to talk about them, but you have to be aware and reasonable, when discussing it. And that's usually comes up again in initial discussions or in negotiations over the term sheet. And I didn't say this because we didn't cover the term sheets, but one of the best things about a term sheet I found is that you can really get a good insight into what the partner is like. What are they pushing hard on? What are they being unreasonable about? What are they willing to give? And it may look, again, like a great deal, but as you're going through the term sheet, negotiating all this stuff, you're going to get a bad feeling about, or you get a bad feeling about them. It's probably not a good fit. You know, this is a little bit like dating in a sense, that you got to find the right match to have a great success. Because there's definitely going to be challenges. There's good times and bad, and you've got to trust your intuition. I know people have walked away from deals because they couldn't negotiate with the other side, and it's hard to do. It's really hard to do, but it's probably the right thing long term, because that was unlikely to be a good partnership going forward. I think I'll conclude there. I mean, I made it through a bunch of them, and open it up for questions. If there are specifics that I didn't hit on that you know you'd like me to, I'm happy to. But why don't I just open it up?
Brian, thank you for doing that, and again, thank you for being with us. So let's take a couple of questions, and then Brian, if you have time to stick around, then we might have yet more Q&A time after Bill's comments. But if you don't, we respect that. We know you've got a busy schedule.
Okay. Yeah, unfortunately, I'm going to have to run. I'd hope to, but please, you can share my contact information. I'm happy to talk to anybody offline, whether it be today or 6 months from now, whatever it is. I'm happy to be a resource to anybody out there.
Very good. So, any questions that you guys might like to put to Brian before he has to run?
I do have a very quick question. And I'd love to also send you some questions for when you have the time. I was very interested in your presentation in the sense that you were trying to compare what we learned from a book to what you've learned with personal experience. That's been personally very valuable. One question that I do have for you that really surprised me was that sometimes stockholders are required to convert their stocks. You kind of mentioned that in your presentation. I just wanted to ask when that is.
It can be, it's usually when there's a corporate action, which means if the company is, going public, they don't, I was trying to find that slide over here, but you might be required to convert your stock in that case, because the other investors don't want you to hold up that deal, and that would be a mandatory conversion. So it would say in your agreement that should the company go public, you're basically going to come along for the ride in a mandatory conversion. So it's usually not something like, it's not punitive. I've never found it to be overly punitive. It's not a punishment or like you're a bad guy, we got to get you out of here, so you have to convert your shares. It's really just a protection for the company at large, to make sure that you can't block something that's probably better. Again, from fiduciary responsibility, that's the slide I just stopped on. If you think that the best thing for all the stakeholders to go public, you don't want a minority shareholder to be able to block that. Because they decide not to convert. Well, I guess if they're a minority, it wouldn't anyway. But that would be an example.
Okay.
Bill, if you say anything else, I'm happy to have anybody else chime in on that too.
Can I ask one last question?
Yeah.
Paola?
Hi, Ryan. My name is Paola.
Hi.
So I have a question for you. It is how many rounds of investment you use for your own company?
For my company?
Yes.
It was one round because it was funded by me. But in reality, I don't know, Dr. Haskell, do you want to, I think you probably have more insight onto that. I mean, because it's tough to answer, right?
Yeah, it is. And thanks, Brian. Paula, you have as many investment rounds for a firm as the firm needs to have enough capital to operate. I mean, you'll find extraordinarily mature firms that have been public for 70 and 80 years will come to the market with what's referred to as a secondary offering, when in fact it may be the 20th offering they've done. It just depends upon the capital needs of the firm and whether or not the firm wants to borrow it or raise equity capital. So it just depends on their needs and what they're going to do with it. You can't raise good money if you don't have a productive purpose for it.
And that,
Thank you.
yeah, that was part of my, something that I meant to touch on before. I've seen a lot of secondaries that are for general corporate purposes, and that's basically saying we just want money in the bank. It's much easier to have a reason. We need to expand our production capacity for the COVID-19 vaccine, and then people can really sink their teeth into the hard stuff that what am I giving my money for, and what's the risk? So in this case, the risk would be they don't make the vaccine, or the sales aren't what they think. But at least you know, as an investor, what you're going in for, or what you're supporting. And Dr. Haskell's right that we talk a lot in terms of equity investments, but debt as well. That's what the markets are there for. The public market, well, all the markets, and you want to do as few rounds as possible because you want to give up as little as of the company as possible, but you have to do it, as the business needs.
Well, Brian, thank you again for taking the time to be with us. We're very appreciative.
Sure. And is there a way for me to have this distributed? Do you want to distribute it? Do you want me to send it to everyone?
I will go ahead and distribute it, Brian. In fact, I put it out on our Canvas site, which is our course management system, so everyone has access to it.
Perfect.
And I'll make sure your contact information is there as well.
Good. That's what I was going to say. I don't think I included that on the front, but that's great. Thanks for entertaining me for a little bit. Let me talk, and please, anyone reach out if I can be of any assistance.
Thank you.